Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Friday, January 6th, 2023, and joining Derek to pose some questions on the financial market themes for the week ahead is Michael Owen, MUFG's Head of Global Client Desk for EMEA in London. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Good afternoon, Derek.
Afternoon, Michael.
Firstly, I'd like to wish all our listeners a happy new year. And then back to business. December jobs report in the US was out today, just released. The number came in at 223,000. Whilst this was a strong number, perhaps the market has focused on the lower wage inflation more so than their overall number in the report. Do you think the Fed's policy will change in any way following this data? And the dollar has weakened following this report. Do you expect this to continue into next week?
Yeah, first of all, I think the labour demand side of the data was obviously very strong. The household survey in particular, the employment increase was 717,000. So even though there was an expansion of the labour force of 439,000, the unemployment rate still fell because of that. So the household survey was pretty impressive. But, there's a lot more focus on payrolls. And as you said, Michael, 223,000 increase when you take out the revision, the downward revision to previous months. It was in or around consensus, but still pretty solid demand. But I guess, one of the kind of key messages we've been relaying to clients at this early stage of the new year is that if last year was all about inflation, this year is going to be a little bit different because, inflation is going to fall unless we get a third global inflation shock. But assuming we don't, inflation is going to fall this year. To what extent and to, how quickly is the big debate. And in answering that debate or getting some color on that, it's one of the big components is going to be wage inflation. And from that perspective, yes, the wages and the weaker print, but also the downward revisions to previous months were notable. And from an upward trend before today's print over the last 3 months, we now have a kind of a flat trend to slightly lower. So the whole picture has changed somewhat, and that is definitely significant. However, of course, the Fed only updated us on their views for where the Fed funds needs to get to, and that is between 5 and 5.5%, 5 and 5.25%, so another 75 basis points. And, has anything dramatically changed because of today? I don't think so, although, we didn't mention, or you didn't mention, Michael, but we also had the ISM data, which was pretty bad. Definitely, that was a bit surprising. The services plunged below the 50 level. The kind of combined economy-wide reading fell below 50 as well. And whenever that has happened in the past, bar I think one example in 2003, recession has followed. So the data is beginning to fall into place for weaker growth. But again, the timeline from what the Fed communicated to us and what they ultimately end up doing, I don't think we can read too much into what's happened just on one day today. So, and by extension of that, we've got CPI next week. So, to answer your question, Michael, more specifically, yes, I think going into next week, we can see the dollar perhaps weaken a little bit more, although the FX move has been less than the rates move. The short-term rates have moved more substantially, in particular on the back of the ISM. But at some point, caution will come back because all you need is one strong CPI print on Thursday, next Thursday, and then it's back to 50 basis points potentially on the 1st of February. And I still think the risks are there that they could do 50 because if they want to get to 5 and 5.25, well, it's best to do it quicker rather than dragging it out potentially. So it's still up in the air, and the data today is certainly indicative of equity markets remaining under downward pressure, although equities have bounced a bit today, but I wouldn't expect that to last. So the broader mix, in our view, given what the Fed still probably has to do, is for some scope for the dollar to recover further from here. And, although today's data puts that into some kind of doubt, we're certainly not changing our view at this point in time. So we still think there's scope for the dollar to rebound somewhat, especially given the scale of the sell-off of the dollar in Q4, which was 9.2%, which was the biggest drop for the dollar, I think, since 2010. So on a quarterly basis. Important data, but I don't think a game changer yet.
Yeah, thanks very much, Derek. And Research Today have just released their annual foreign exchange outlook. Could you outline to our listeners the key takeaways from this publication and what you think will be the key drivers for the FX market in 2023?
I just spoke there about the potential for the dollar to bounce back a bit after the scale of weakness in Q4. But the 2023 view is that bar a first quarter rebound of the dollar, we're then going to enter into a period of dollar depreciation. So we've got euro dollar at the end of the year at 112, having dropped potentially close to parity in Q1. So that kind of profile. It's largely on looking at what the main macro driver last year, which of course was inflation and the Fed leading the way in terms of rate hikes. And, we think that comes to an end, obviously. And inflation's going to come down, we think, again, as long as there's no third global inflation shock. So the whole macro backdrop is going to change somewhat. And I think in that sense, it's likely the dollar's going to weaken beyond the Q1 period of strength that we expect. There's other factors, global relative macro. If you consider the UK and the Eurozone, and China, while not in recession, the UK and the Eurozone are probably in recession. China growth is very weak because of COVID. You're having reopening, which will start to show in the data in Q2, Q3. Similarly, we could start to see investors anticipating a pickup in growth in Europe. And at that time, we're going to have kind of recessionary conditions, probably in the United States. So I think that the relative macro story in terms of global growth being somewhat better relative to the US than what we had last year, that also points to the potential for the dollar to weaken later this year. And then, we can't ignore valuation. The levels that we got to last year, at one stage we were up over 20% year to date. And I think the scale of the depreciation in Q4 was in part indicative of how extended we had become and the valuations being stretched. And there's probably no better example of that than dollar yen. And one of the takeaways we have for this year is that, we think that drop in dollar yen that we had in Q4, that's basically going to continue. And there's more to go on that. And we can certainly get down to around the 120 level by the end of this year. The BOJ, another takeaway is the BOJ's policy is going to be a lot more in focus this year than last year. Last year was obviously about doing nothing up until the final moment in December. And because of that, we're calling it the BOJ letting the cat out of the bag, because ultimately, they've been telling us all year that the macro conditions didn't warrant a change, but then they did change yield curve control. And I think that first change means the markets are going to be looking for more and more. And I think it's inevitable once we get a new governor in the BOJ in April, that more policy normalization is going to take place. And on that backdrop, again, with the Fed possibly by the end of the year looking at cutting rates, certainly in 2024, in that context, the whole relative policy story changes. So dollar yen declining continues. There are other kind of takeaways. I think possibly on the pound, we've become a little bit more positive on the pound. We just get a feel that maybe we've reached peak pessimism, or we're about to. And as we go through 2023, we could see some period of outperformance for the pound. We've got Rishi Sunak as PM. Credibility on fiscal policy should be that bit better. You've got a current account deficit, which was very much highlighted as a negative in 2022, and we were highlighting it as well. But when you take the 4 quarters to the most recent data available, the current account deficit is now 4%, just over 4% of GDP. Still big, but it's not as problematic as the Q1 annualized figure was, which was close to 8%. So the current account situation isn't as bad as it was. And then there's this recent mood music improvement in relation to a deal on the Northern Ireland Protocol, with the EU acknowledging that the protocol was possibly too onerous on the UK. So that, again, is a positive development that could, I think, help sentiment for the pound later in the year. So peak pessimism on the pound could be here, and we've got a better outlook for the pound going forward. And then, of course, the energy trade of terms shock that has been such a huge negative for the likes of the yen, euro, and the pound. We're just not going to get a repetition of that. Our energy analyst does have higher energy prices this year, but the scale of change compared to last year and the year before is going to be completely different and much less. And therefore, that negative terms of trade shock on those currencies will just not happen this year. And that's another positive for those currencies versus the US dollar. And then, sorry, very quickly, I know I've got on a bit, but QT is a big theme for this year. Most of the heavy lifting in terms of interest rates has been done. So we're going to go to pause, possibly at the end of Q1 for a lot of central banks. But QT is taking place 7 of the 10 G10 central banks. So there's going to be a huge amount of liquidity coming out of the markets this year. We estimate about $3 trillion just for the major central banks in G10. So that is going to have repercussions in terms of increased periods of volatility and certainly for fixed income markets as well. So that's a theme that will come and go perhaps, but will have implications for FX from time to time as well.
Yeah, thank you very much, Derek. And finally, there's obviously no FX Weekly today as we have the FX Annual Outlook published, which hopefully everyone sees. But just to update us on your trade ideas, did you run any trade ideas through Christmas? And I know we've talked about a lot already, but is there anything that's been grabbing your attention?
We did. So we had a short Aussie Japanese yen trade view, which we cut just before Christmas. That did work in our favor, but of course, dollar yen has been rallying now, so that's kind of reversed to about where we had it on. So, and yeah, going forward from here, obviously, our first FX Weekly will be next Friday, which will be the day after the CPI print. So, I think that will give us the colour required for taking a clearer view. Obviously, if the CPI is weaker, we may well position for further dollar weakness. But obviously, the flip of that would be that the dollar could rebound if inflation is stronger than expected. So, yeah, we'd probably wait until that date and take it from there.
Thank you very much, Derek, and wishing everyone a good week and year ahead.
Thanks, Michael.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and reach out to your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.